Stop doing this one thing if you want to keep loving your favorite food. Ever heard of marginal utility? So, imagine you have a delicious chocolate bar. The first bite, absolutely heavenly, but by the fifth bite, it's just okay. That's because of something called marginal utility. Marginal utility is the satisfaction you get from each bite. The first bite brings maximum joy, but with each bite after, that joy starts to fade. It's like watching your favorite movie over and over. The excitement just isn't the same every time. So next time your favorite snack doesn't taste as awesome, remember it's just marginal utility doing its thing. Keep things fresh by mixing it up, and you'll always enjoy your treats. Let's talk about two types of expenses, fixed and flexible. A fixed expense stays the same every month, like rent or your phone bill. In contrast, flexible expenses change, things like gifts, car maintenance, or your electricity bill. In a free market economy, prices fluctuate because of the economic exchanges between consumers and producers. Supply and demand play a major role in determining these prices. For example, during holiday seasons, the price of gifts might go up due to higher demand. On the other hand, if there's an abundance of a product, its price might drop. Understanding the difference between fixed and flexible expenses can help you manage your budget more effectively. By keeping track of your fixed costs and preparing for variable ones, you can ensure you're never caught off guard. So next time you're planning your monthly budget, remember to account for both types of expenses. Balance them wisely and you'll have more control over your financial well-being. When people have more money, they tend to buy more. This phenomenon is known as the wealth effect. With an increase in income, people start purchasing more normal goods such as cars, vacations, and high-end electronics. These are items that enhance their lifestyle and provide a sense of luxury. However, the reverse is also true. When people have less money, they turn to inferior goods, budget items that help them save money. This might include generic brands at the grocery store or opting for public transportation instead of owning a car. The wealth effect explains why consumer behavior changes with income fluctuations. As people's financial situations improve, they upgrade their purchases to reflect their newfound wealth. Conversely, during tougher times, they downscale their spending habits to make ends meet. Understanding the wealth effect can help you make more informed decisions about your own spending. By recognizing how income impacts your purchasing choices, you can better manage your finances and plan for future changes in your economic situation. So whether you're experiencing a windfall or tightening your belt, being mindful of the wealth effect can guide you towards smarter financial decisions. Elasticity measures how much consumers change their buying habits when prices change. For inelastic goods like housing and food, demand remains steady even if prices go up because people need them. However, for elastic goods like luxury items, a price increase leads to fewer purchases. Think about it. If the price of a luxury item skyrockets, would you still buy it? Probably not, because it's not a necessity. This concept helps businesses and policymakers understand consumer behavior and make informed decisions. For example, a government might impose higher taxes on inelastic goods like tobacco to discourage consumption without significantly affecting demand. On the other hand, businesses selling luxury items need to be cautious with pricing, as their sales might plummet with even a slight increase. Understanding elasticity can also help you make better financial decisions. By recognizing which of your purchases are elastic or inelastic, you can adjust your budget more effectively in response to price changes. So, the next time you see a price hike, you'll know exactly how it might impact your spending habits. Public goods are available to everyone, whether they pay for them or not. For example, a public park or a parade can be enjoyed by anyone, including those who didn't contribute financially. This leads to the issue of free riders, people who benefit without paying. Because public goods are non-excludable, producers often have little incentive to provide them since there's no guaranteed payment. Imagine a beautiful public park in your city. It's a place where you can relax, exercise, or enjoy a picnic with family and friends. Now think about how this park is funded. It's likely maintained by the city's budget, which comes from taxpayer money. However, not everyone who uses the park contributes to its upkeep. This is the essence of the free rider problem. Governments and organizations have to find ways to fund these public goods despite the free rider issue. This could mean using taxes, donations, or even implementing membership fees for certain facilities within the public space. The challenge lies in balancing accessibility with sustainability. Understanding the free rider problem can help you appreciate the value of public goods and the importance of contributing to their maintenance. The next time you enjoy a public service, consider the effort and resources required to keep it available for everyone. Prices change in response to supply and demand, and technology plays a significant role in shaping these dynamics. Technology can lower production costs, making goods cheaper and more accessible, but it also introduces competition on a global scale, meaning businesses must innovate to stay relevant. In this ever-evolving market, both prices and jobs are impacted by technological advancements. For instance, consider the smartphone industry. Technological progress has led to more efficient manufacturing processes, reducing costs and allowing companies to offer advanced features at lower prices. This benefits consumers who enjoy better products without breaking the bank. However, this also means that manufacturers must continuously innovate to stay ahead of competitors, often leading to job shifts within the industry. Automation and artificial intelligence are other facets of technology that significantly influence the job market. While these advancements can enhance productivity and reduce costs, they also pose challenges for workers whose roles may become obsolete. On the flip side, new technology creates opportunities for skilled jobs in emerging sectors requiring a workforce that can adapt and learn new skills. Understanding the interplay between technology, prices, and jobs equips you with insights into how our economy evolves. It highlights the importance of continuous learning and adaptability in a tech-driven world. As technology continues to advance, staying informed and flexible becomes crucial for navigating the future economic landscape. In this unit, we explored key economic concepts, from marginal utility and elasticity to public goods and the wealth effect. Understanding these principles helps explain why prices change, how people react to income changes, and how public services benefit everyone, even if not everyone pays for them. Let's recap some of the major points. Marginal utility helps us understand why your favorite food might get boring over time. The more you consume, the less satisfaction you derive from each additional unit. This concept is crucial for businesses when setting prices and for consumers making purchasing decisions. Elasticity shows us how sensitive demand for a product is to changes in price. If a product is highly elastic, a small price increase could lead to a significant drop in demand. This knowledge helps businesses strategize their pricing and marketing efforts. Public goods like clean air and national defense are tricky because they benefit everyone, regardless of who pays for them. This often leads to challenges in funding and maintaining these essential services. The wealth effect explains how changes in income levels influence spending habits. As people earn more, they tend to spend more, driving demand for various goods and services. This relationship is vital for understanding consumer behavior and economic growth. Finally, technology's impact on prices and jobs is profound. It can reduce production costs and make goods more affordable, but it also introduces competition and shifts in the job market. Workers must adapt and learn new skills to stay relevant in a rapidly changing landscape. By grasping these concepts, you are better equipped to navigate the complexities of our economy. Stay curious, stay informed, and remember that understanding economics is not just about numbers, it's about the choices we make every day. Thank you for joining us on this journey through the fascinating world of economics. Until next time, stay economically savvy.